$30 billion, that's what Amazon committed to buying its own stock in 2024. And if you hold Amazon shares directly or via an S&P 500 index fund, your portfolio may have just paid the price without knowing it. Most investors see buybacks and think, great, the company's returning capital to shareholders. But research from the Journal of Finance shows something else entirely. When megacap companies like Amazon fund buybacks from foregone R&D or debt instead of organic growth, EPS inflates artificially, while actual economic value creation slows. This isn't theory, this is measurable drag on your returns. Here's the personal impact. A household with $500K in Amazon or S&P 500 exposure experiencing just 1% annual drag from this capital misallocation versus an 8% organic growth opportunity costs you $40, $000 to $50, $000 in compounding over 1 decade. That's 18 to 36 months of delayed retirement, potentially pushing your target date from 60 into your early 60s. Let that sink in. One capital allocation decision by one company's board could move your retirement back by years. Let's break down what Amazon's actually doing with that $30 billion and why the timing matters right now. First, the scale. Amazon's 2024 10K filing shows $30 billion in annual share repurchases, represents 6 to 8% of free cash flow. That's not a rounding error. Compare that to capex and R&D investment. Amazon spent roughly $60 billion on infrastructure and technology development last year. The buyback isn't supplementing that, it's directly competing for the same pool of capital. Every dollar spent buying back shares at current valuations is a dollar not spent building the future infrastructure that would drive organic growth. Now here's the hidden detail most investors miss. When you buy back shares at elevated multiples, you're reducing the per share denominator while earnings growth stays flat or slows. EPS appears to rise, stock price follows, but the underlying business hasn't actually created more economic value. It's just been reallocated from reinvestment into financial engineering. It's a sleight of hand that looks good in quarterly earnings reports but hollows out long-term competitive advantage. Brav et al. At the Journal of Finance analyzed 500 plus buyback announcements across 20 years. Their finding is damning. Companies that relied on buybacks rather than organic growth showed 40 to 50 basis points of underperformance versus peers that reinvested that capital over 15 years. That gap compounds into real retirement timeline risk. We're not talking about small differences. We're talking about structural underperformance baked into the capital allocation decision. For Amazon specifically, that $30 billion could have funded 3 to 4 major data center expansions, accelerated AI infrastructure build-out, or funded next-generation AWS capabilities, the division that actually drives profits. Instead, it's buying back shares at valuations that are already priced for perfection. The opportunity cost is real, and it hits income investors hardest because you're counting on growth compounding to fund retirement, not on buyback-induced price inflation. Here's why this matters right now. Amazon's Q3 and Q4 2024 earnings, announced Jan-Feb 2025, and the 2025 capital allocation guidance will signal whether this $30 billion annual commitment continues or pauses. If it continues, expect sustained 5 to 1. 5% annualized drag on your megacap tech returns versus a scenario where that capital flows into organic growth. That's not noise, that's systematic value destruction. The one metric Amazon doesn't want you calculating: free cash flow yield divided by capex intensity. When buybacks exceed capex growth, it signals the company is prioritizing stock price over infrastructure, over the actual engines of future revenue. You can audit this yourself in the 10K cash flow statement, line items, operating activities, minus capital expenditures divided by shares outstanding. For a dividend income investor, the risk cuts differently. You're buying Amazon or tech-heavy index funds for growth compounding, not yield. If that growth engine is starved by $30 billion in annual buybacks, your total return, price appreciation plus any dividend, faces structural headwinds. A 1% annual drag over 15 years to retirement becomes $150, $000 to $300. 000 in foregone, compounding on a $500K position. The action step: audit your largest tech holdings right now. For each position, pull the 10K. Calculate free cash flow and capex as a percentage of that FCF. If buybacks exceed 30% of FCF and capex growth is flat or declining, flag it. That's a signal capital allocation is tilted toward financial engineering rather than organic growth, and it may be time to reassess position sizing or diversification before the 2025 earnings calendar crystallizes these hidden drags. In strategy, the quiet observer wins.